Let's continue with chapter 3. On Thursday, we're going to play Jeopardy on chapter 2. Next Tuesday, I plan to finish chapter 3. And the Tuesday after that, we'll play chapter 3 Jeopardy. All right, we already talked about common size financial statements. We talked about short-term solvency ratios such as current ratio and quick ratio. We started discussion of long-term solvency ratios. There are two types of those. One is called the leverage ratios, things like that equity ratio. And we had ratios that are similar in nature. One of them is equity multiplier, which is total assets divided by total equity, which happens to be 1 plus that equity ratio. Another one is total debt ratio, just to remind ourselves. Oops. We could write total debt ratio as this. Remember, total debt ratio is total debt over total assets. Or we could write that equity ratio as so if I give you any one of these, you should be able to calculate the other two. It's not that complicated. But either way, if you're using these for analyses, they contain exactly the same information. It's just a different way of looking at it. Now, we have more solvency ratios to talk about. We're going to talk about coverage ratios. These two are different ways of looking at how much debt you have. The first one literally looks at how much debt you have. Uh, you know, think about for your own experience. You have so much credit card debt, so much student debt, uh, which you haven't seen the pressure yet because you don't have to pay them back yet. Trust me, by starting 26th of this month, I'm going to feel the pressure of that. I got a lot of parent loans for my kids, and my older son graduated, so I'm going to have to start making payments. But, I know that was coming. Debt equity ratio, for example, looks at what is your total balances divided by your net worth. On the other hand, coverage ratios looks at your ability to service that debt. For example, I don't think any of you have done this, but if you applied for a mortgage, let's say you have an 800 credit score, which is considered excellent. If you're approved, you'll get the best rates, but they would also look at something called debt income ratio. It's kind of misnomer. They actually look at total monthly payments on debt, and they divide it by your income. If that number is over 40%, you're not going to be approved for a traditional mortgage. Why? Because, if you're spending already 40% of your money on debt service, and now you're going to get new debt, plus you have to live, how is that going to happen? That's the only reason. Even though I own no property, I have about $500,000 mortgage on me because I had to co-sign for my ex. She didn't have enough income, even though her credit score is actually better than mine. And now, if I wanted to buy something, I don't think I can qualify for it, even if I had 850 credit score. I don't. These look at, given how much money you make, something like net income, what is your ability to cover your interest payments? The first one we're going to talk about is times interest earned. We're going to abbreviate that to TIE. For that, we're going to divide EBIT by your interest expense. And EBIT is short for interest before interest, earnings before interest and taxes. That's the number we want to look at because remember, I paid as a corporation, I make my interest payments before I have to worry about taxes because taxes are not determined before you make the interest payments. Plus, I'm not going to look at the interest payments. So before I have to make the interest payments and taxes, to what extent I can cover my debt service. There is no hard and fast rule, but you want I to be significantly greater than 1, kind of a rule of thumb, at least 2 on a kind of consistent basis. Since earnings are to some extent affected by choice of accounting methods, every once in a while your times interest ratio may be too low, but I'm not going to worry about it if that can be explained by choice of accounting methods. One of the things that affects EBIT or choice of accounting methods affects quite a bit is we have to worry about depreciation and other non-cash expenses, such as stock-based compensation, amortization, or one-time charges you take, such as on goodwill and that sort of stuff. The ratio we're going to use for that is called cash coverage ratio, and that's going to be EBIT plus, I'm going to generically call it non-cash expenses, and divided by interest. General name we give EBIT plus non-cash expenses is EBITDA, which is short for earnings before interest, taxes, depreciation, and amortizations. But you can think of that as generally non-cash expenses. Every once in a while, firms take one-time charges. For example, they're restructuring. That is a non-cash expense. They're basically saying we're going to lose money in the future because of this, so I'm taking that charge now. When you're making calculations like these, you should think of those as non-cash expenses, which they are, and account for them. Again, I'm going to abbreviate this to CCR. I want CCR also to be significantly greater than 1, probably at least 1.5. Again, that's kind of an arbitrary cutoff. As a creditor to this firm, you should make your own judgments. But if it's 1.25, I'm gonna be worried about it, whether or not, on a consistent basis, whether or not these people will be able to make those payments. For example, let's download financial statements for Netflix, a company that I know to have a lot of debt. Come on, let's just get their 10K. Oops, that's not what I wanted to do. Hit the filing, interactive data, Excel document. Yeah, yeah, yeah. I like you too. Netflix has a fiscal year that ends at the end of December. Okay. Let's look at, they call it statement of operations.